Hello friends, Chris Lee, CPA here with another video talking through, tax items that are relevant to entrepreneurs, and hopefully with the goal of helping you build your businesses and build your wealth in a smarter, more tax efficient way. So today we are going to talk about one of the more meaningful items of legislation that has come about in the last 2 years and has kind of been retained through the One Big Beautiful Bill Act, the tax legislation that passed in July of this year, July of 2025. And we're going to talk about how that interacts with what is known as the Pass-Through Entity Tax deduction, or PTETs. And this is most important to, S corporations, partnerships, and LLCs that are taxed as S corporations or partnerships. So this is just be informational as always, and for your specific facts and circumstances, always be consulting a tax professional so that you can effectuate your tax planning in the appropriate way. So before we dive in, let's talk about first state and local taxes. And their deductibility. So state and local taxes are an itemized deduction generally for individual taxpayers. So what that means is that you've got to add up all of your relevant deductions that are to be itemized, itemized to mean laid out specifically. Usually we do this on Schedule A. And so we add up certain medical expenses, your state and local taxes, which are income taxes, real estate taxes, property taxes, those sorts of things, that bucket right there. Then we add up our deductible interest, which is usually interest on primary residences. You can get some investment interest deductions, and you've got primarily charitable deductions, both cash, non-cash, those sorts of things. And then a couple of other items sometimes can be deductible, casualty losses and those sorts of things, but those are more rare. Usually when we think of itemized deductions, we think of medical expenses, medical tax, state and local taxes, interest, and donations. Those are like the 4 categories we're primarily working with. And in total, you've got to add all of those up, and they have to be over the standard deduction. The government gives every person filing a tax return a freebie of deductions. It's called the standard deduction. And you get those regardless of, amounts you spend or anything like that. For state and local taxes, it's just a freebie. When you itemize your deductions, you're looking to add up all of those 4 categories, subject to certain limitations in each of those buckets, to exceed those standard deductions, and then that's kind of the deduction you get instead of the standard deduction. And so within those 4 categories, we've got the state and local tax deductions, that bucket. That bucket back in 2017 became subject to some restrictions. This is a result of the Tax Cuts and Jobs Act, and they became limited to a total of $10,000 per year. So that's the max amount that you are going to deduct for state and local taxes, regardless of the amount that you paid. So this cap was really difficult for high tax states and also high income earners. So the higher the income, the more state local taxes you pay, but there's still, no matter how much you pay, that deduction was a 10% deduction. And so the states, as a workaround, transitioned to, brought out these opportunities of what's called pass-through entity taxes. So pass-through entity taxes are essentially to say that rather than you paying your state income tax on your business profits, so again, businesses that are pass-throughs, that are, S corporations, partnerships, or LLCs taxed as corporations or partnerships, rather than paying those taxes that generally are the result of income coming through a pass-through entity, pass-through income from a pass-through entity, that you land on your personal tax returns, federal and state, and you pay taxes there, you're going to elect to have the business, the S-Corp or the partnership, pay those taxes directly. So when your S-Corp, partnership, or multi-member LLC pays the tax at any level, the payment becomes federal business expense, a deductible, ordinary, and necessary business expense that everyone likes to talk about under 162. So what that means is, when you choose to pay those taxes at the entity level, you are bypassing those limitations that otherwise would apply to cap you at the $10,000. Now, we'll talk about that $10,000 cap here in just a second, but that's functionally what they're doing. Is rather than making those a deduction on your personal tax returns subject to your itemized taxes, subject to that $10,000 limitation, we just say, okay, the entity paid this. It's a business expense, an expense of the business. and it gets deducted on the business tax return. And so that's fundamentally what we're doing. Now, with the legislation that passed in July, known as the One Big Beautiful Bill Act, OBA, the federal SALT deduction cap got enhanced starting in 2025 up through 2029. So rather than the cap being $10,000, it's now $40,000 for most taxpayers. Married filing separately is going to be $20,000, and there's a phase out of it. So once income exceeds $500,000 for married filing jointly, or $250,000 for married filing separately, the cap of $40,000 is reduced by 30% of the excess. So the amount of income that's over $500,000, 30% of that excess reduces that $40,000 cap, not below the $10,000 floor threshold. So everyone still gets the $10,000, but high income earners with, business income, wages, everything coming into your, tax return at over $500,000, you're going to end up reducing your deductible state and local taxes. And most people a lot of my clients are going to end up at that $10,000 threshold. So we need to manage that, right? We're paying more taxes at the state level, and we want to make sure that those aren't going, without some amount of federal benefit. So the consequence, again, is the workaround that we primarily use is this PTET election. It's totally legal, and there was talk during the legislative process for the One Big Beautiful Bill Act that they were going to limit the capacity for doing these pass-through entity taxes, but it didn't end up making it into the final legislation and therefore not being passed. So we still have the opportunity to do these pass-through entity taxes. Now, as of 2025, approximately 40 states have enacted these pass-through entity taxes, PTET regimes, making them the norm rather than the exception. So it took a few years for them to get hold, but most states now actually, have the option to do this. And so they can be widely adopted there, and it's a state-supported workaround for federal taxes. So that's really what we get to with it. So when we go to make a pass-through entity tax election, different states have different deadlines for making those elections. So some states have an election deadline that would be the same due date as the entity's state tax return. So whether that's, March 15th or April 15th, depending on your state. And so once you make that PTET election, all owners of that pass-through entity, of the S corporation, of a partnership or LLC taxed as in one of those ways, are bound by it. So most states are going to require that every owner participate. Every owner that's going to receive a K-1 from this entity, this pass-through entity, has to participate and is bound by this decision. So most states don't let individual owners to opt in or opt out of pass-through entity tax. It is a group election. Everyone must participate, resident partners and non-resident partners. The reason people might consider not electing into this is because it is paying tax at the state's top individual tax rate rather than maybe a lower rate. Some states have what is a flat tax, other states do not. And so, for example, California has a graduated tax system and has, higher tax rate, 10% plus, depending on what's happening. And so electing to pay tax around that is really expensive, when if you were to actually just let that income pass through to your return, you might be paying at a lower tax rate. But paying at that lower tax rate, you still might end up with limitations of its deductibility on the federal return, where it has an even higher tax rate. So that's where we get into tax planning and tax modeling, is figuring out what the right answer is for you along the way. So most states have a top individual tax rate around 4 to 6%, which makes it usually not that much more expensive to choose the PTET election over just letting the income pass through to your individual return and then paying the tax on your personal tax return. Now, what happens when the pass-through entity does pay the tax? So it deducts that income, it deducts that state tax paid in its business income, and then it passes that income net of the state and local taxes paid to you. And then on the state tax return, states handle this, right? Because you've already paid it. And usually most states, the starting point of your state tax return is your federal tax return. Well, your federal tax return has already deducted those state and local taxes in that income that's flowing through. So the starting point on your state tax return is generally going to be a federal total income or federal adjusted gross income. Just kind of depends, but that's typically what you're looking at. And then the state has two mechanisms by which they make sure that that income doesn't get double taxed, right? Because that pass-through entity tax is already elected at the entity level. So states handle it one of two ways generally. One, they'll say, okay, income that was subject to the pass-through entity tax, we're going to adjust that out of your federal AGI on the state return. Or what a state might also do is say, hey, you've already paid tax on this, so we're going to give you a credit against that income that is being, has tax calculated on it. So you're going to get a statement from the pass-through that says this is the amount of state tax paid on your behalf. Apply that against the tax that's computed on your state tax return for that income. And so it kind of offsets the two. So those are the two mechanisms by which states usually make sure that that income doesn't go double taxed. So that's primarily what we're looking at with these, is really getting around these what we call SALT limitations, state and local tax deduction limitations. And that $40,000, which for even higher income taxpayers, it gets down to $10,000, right? Because it phases out. And so that's really what we're just trying to manage here, and make sure that the taxes you're paying at the state level receive an appropriate amount of attention as far as what is your actual profits to take away from a business and be subject to federal taxation. So over the next few years, like PTETs are going to be, they're maybe less applicable than they were previously because our SALT limitation is higher. However, this still assumes that you're going to be itemizing your deductions. And so if you're not going to be itemizing your deductions, it actually lets you compound and stack on top of that standard deduction. And so in general, it's probably the best, thing to do regardless, is like, if it's available, just do it. The only real downside to it is, rather than making estimated payments just on your personal tax return for federal and state purposes, you've now got, generally, most states are going to require estimated payments for the entity level pass-through entity tax election at the state level. And then you have the personal, federal, and state estimated tax payments. So you're making 3 different sets of, estimated tax payments versus 2. But in total, like, this ends up being an extra 20 to 30 minutes a year, of maybe making a manual payment. And I mean, tax affected, some people save $10,000, $12,000, $15,000 a year, a federal tax benefit from making these elections. And so that's a pretty good rate of return, right? Like, for 20 to 30 minutes of return of work a year, saving $8,000, $10,000, $12,000 in taxes. And so the key takeaways are that gotta check with which state you're going to be filing in, and make sure you understand the timing of the elections. Some states do have a requirement that you elect by the end of the year, before the year of the end closes. That's an unusual circumstance, but there is one state that I can't recall quite at the moment that does have such a requirement. You do need to make sure that all owners are willing to elect into this, and not just electing this on behalf of all owners of the pass-through entity. So whoever's the manager of that entity that's going to be coordinating distribution of K-1s and has the responsibility of communicating with the owners, it's super important that you actually, maybe a written election, it's worth, maybe even sending that out every year. Like, yes, I will elect, and yes, I agree. If not, then everyone's kind of, out of luck for that. So, and then we also want to think about, if we're going to put a pause on the pass-through entity election, because you can get largely the same benefit on your state and local taxes because of the increased SALT cap, we want to make sure that, as that increased state and local tax limitation phases out, after 2029, that we're being conscientious of potentially electing back into this regime to make sure that we're getting all the benefits. So it's something to consider as you're doing your tax planning, and particularly year-end planning. That's some things we will want to be thinking about, and it's something to think about at the beginning of the year as well. Just because most states are going to require that you make estimated payments, and so should you fail to make estimated payments throughout the year, you could be subject to interest and penalties for underpayment of estimated taxes related to these PTET taxes. So if you are implementing this late in the year, just keep in mind that there could be a small amount of interest and penalty subject to you for making those payments later in the year. But most of the time they're pretty small, And so the benefit is still there, even when you consider those consequences. So yeah, going forward, it's a great strategy that, I would say almost every pass-through entity owner should be doing to maximize deductions and lowering federal tax liability. It's particularly relevant for high-income business owners. Yeah, that's pretty much it, and that's the crux of the items. Sometimes you really do want to model these things out. If you're going state by state, if you're a multi-state entity and you're going to be doing pass-through entity elections at different states, because of those marginal tax rates getting so high, a lot of times you end up balancing, okay, if I make the PTET payment, or if I choose to PTET in one of these states where I've got activity, and if I file PTET, then I don't have to file an individual tax return, but I'm paying at a much higher rate than I would if I otherwise had to. What is the cost of compliance, a multi-state personal tax return and filing in all of those filing in those non-resident jurisdictions? What's the taxes saved net of the additional compliance fees for actually avoiding the PTET and filing in those states? And so this can get complicated when you've got like a multi-state entity and you're choosing PTET elections in multiple jurisdictions. You could make a choice. There can be good reasons to, choose in certain jurisdictions to go one way and other jurisdictions to go another way. But this is where modeling happens, and this is where it gets down to working with a professional to figure out like what the best answer is for you. So with that, I recommend you be on the lookout for new videos, watch and subscribe, and I will catch you on the next video. Take care. Bye.